How would you like to know what property values are going to be at the end of the year? Would you like me to forecast what property values are going to be in 2 or 3 years' time, or what the best growth areas are going to be? Of course we all like forecasts. We want to know what's ahead. We'd love to have some certainty, especially in today's market when there is so much uncertainty. But let me bust a myth about forecasts. The myth is that forecasts actually work. No, they don't. So in today's show, Pete Wargent and I are going to chat about forecasts, and if they don't work, what you can do instead to have a better grip of what's ahead and how you can outperform the markets. Unfortunately, there are so many people out there giving forecasts, some more accurate than others, forecasts about interest rates, forecasts about properties, and the media loves them. I know they're the type of blogs and podcasts that get the most listens and looks at, but let's unpack some truths about them today. So welcome to today's episode of the Michael Yardney podcast, where Pete Wargent and I share our thoughts about property forecasts. At the end of today's show, you'll have a better understanding of what you should be looking for instead.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator who has once again been voted Australia's leading property investment advisor. That's the 5th time he's won a similar award in the last 7 years.
2020 is going to be a very different year to what many of us were expecting. There were bushfires at the beginning of the year, tragic bushfires, and then there was problems in the Middle East. But out of the blue, that black swan event, that X factor that we always talk about came, but it's a bigger one than normal that's leaving us with a level of complexity and uncertainty for our future. That's, of course, the coronavirus. Everyone's spoken about the coronavirus, so I don't particularly want to spend time on that today, but what I would like to have a chat with my regular guest, Pete Wargent, is about forecasting, how useful it is, what we can do about it, how you get it right, why people get it wrong. So welcome, Pete.
Pleasure, Michael. Always great to be on.
Now, we know that forecasts don't seem to work too well, but on the other hand, everyone still keeps doing it, Pete.
Yeah, one of the analogies I use when it comes to forecasting, I think back to when I was at junior school and one of my mates was into chess. And I thought, well, this seems like essentially quite a simple game, because when you start in chess, you've only got the pawns and the knight that can move. So there's only 20 possible positions after the first move. But then the player on the black team or side moves, and then suddenly there's 400 possible positions because it's 20 by 20. And after 4 moves by each player, suddenly the number of possible positions is just unfathomable. It's like 288 billion. And that's just after 4 moves. So, and it's a bit like this when it comes to forecasting and financial markets. If you think about the number of variables and then how each of those variables could differ and then multiply them by each other, I mean, it's completely insane to think that we could possibly forecast accurately. We can't. It's deceptively reassuring for people when they hear stock market forecasts or whatever, but the reality is people can't forecast accurately.
Having said that, those blogs, those podcasts that are going to tell you what the forecasts are going to be. In fact, one of the most popular blogs on Property Update is the forecast for property in 2021. It gets thousands of views every day because Google keeps linking to it. That's what people want. I guess they're looking for some certainty when it's not really there.
No, but what you can do is you can think in terms of probability, and that's the most important thing. Nothing is a yes or no answer. What people really want is a forecaster to ask the right questions and then answer them as accurately as they can with some kind of probability. So it's about being approximately right and not precisely wrong, and forecasting to a decimal point. We see this in property market predictions at the suburb level to, 1 decimal point over 5 years. It's complete madness. Of course, you could never do that. But what people really want is an approximately right forecast.
That makes sense. I also know some people who do 40-year forecasts and spreadsheets and tell you where you're going to be then. There are just too many variables. One way I've got around it, Pete, is to have expectations rather than forecasts. So I expect the property market to turn down again. But I don't know really when that's going to be. I expect interest rates to go up again, Pete, but not in the near future, and I don't even know when that's going to happen. And I expect some of my investments are going to do better than others. But again, I'm not always sure which they are. And it's not a cop-out, Pete. By expecting, I actually invest differently. I think differently. So I'm actually prepared to ride the ups and downs, to have right financial buffers, to know that I'm not actually going to always get it right. And things like those incidents we've had this year are going to come out of the blue to make my best forecasts with all the research and all the homework to blow them out of the water.
That's tell you, well, you've completely nailed it. That's totally it. So, anyone can build a sort of an as-if model that forecasts into the future. And it seems quite alluring because it can give very precise inferences about the future. But the problem is the real world gets in the way and the assumptions don't hold up in real life situations. So the future is uncertain. That's inherent. So you do need to question models and forecasts because the more you know, the more you don't know. But rather than a precise projection, the most important thing is just a very high level of accuracy in asking and then answering the right questions. So it's more about just having the framework for success rather than trying to predict what's going to happen, because the future is much harder to predict than we think.
Well, Pete, let's go through a couple of ways of preparing for the uncertainty, because there is uncertainty floating around in there. Let's have a talk about what you think we should do.
Well, one of the things, when you see forecasts, one of the things is just to check what your gut instincts tell you, because a gut feel is never any replacement for hard information. But your unconscious response can also be a useful sense-checking tool. So if somebody comes to you with a forecast and it just seems too optimistic or too pessimistic, if that's what your gut feel is telling you, that's a good place to start. The track record of the forecaster is another thing that you should take into account, but also just the model. What model are they using? I'll give you an example. In stock markets, I think back to the peak of the market during the financial crisis, and we always get this at the start of the year. Where do you think stock markets will be at the end of the year? All the economists, there's usually 25 or so, will say, well, at the end of the year, we think the market goes to 8,000, and then finish the year at 3.5. Yeah. So if forecasts, they're obviously not using the right model, because if a forecast can be that far wrong, even in 12 months, it's next to useless. It's an interesting guessing game, but what you really need is the right model. And the model for stock markets is the market cheap or expensive, and that should determine your exposure, not what somebody's guess is about the future.
So, Pete, with that in mind, then what else can we do to position ourselves to take advantage of the uncertainties and not get caught in the challenges ahead?
So, yeah. The future is uncertain, that we know that. So they say that history is the study of surprising events. And then for some reason, we then think we can predict the future, even though we've been constantly surprised before. So a really good read on this, Nassim Taleb, The Black Swan. He talks about how these events, including in places like Lebanon and elsewhere in the world, we think one thing is going to happen and then something completely different happens. 9/11 is another good example. Nobody had expected such a thing could ever occur, and therefore there was no protocol for defending against it. So if the future is that uncertain, there are 5 things I would say that you can do to position yourself for an uncertain future. I think firstly, you need to be, if you can, be somewhat flexible. You see this with very large businesses. Sometimes if they've got thousands of employees with strictly defined roles, it's very difficult for those to turn around. You've seen this with the big car manufacturers and other businesses. So having some flexibility and a lack of resistance to change, that can really help you to capitalize on new opportunities as and when they come around. So firstly, so be flexible, don't be narrow-minded. Second thing is to understand and limit your downside, because if we do get black swan events, the trick really is to look for asymmetry. So big upside, big open-ended payoffs, but a limited downside. So try and protect the downside. The third thing which flows on from that is seeking unlimited upside. So when we talk about real estate, we always know there's ups and downs through the cycles, but we do know if you pick high quality assets in the right areas, over the long run, the compound growth can, it can see seemingly limitless upside. So you might have comparatively little to lose. Now, a couple of other things that you can do to position for an uncertain future. One thing is to mingle, because great things happen when you meet people face to face. So Wealth Retreat is a great example of this. I would go just for the educational content, but the networking, the ideas, learning from mentors, successful people, great things happen at cocktail parties and business events because barriers are broken down when you meet people face to face. And I think the fifth and final way to position for an uncertain future, there's a phrase that says play in a big pond, because if you live or invest in a big city, that really increases the odds of serendipitous events. So say I live in Noosa, that's not actually the best thing. If you want sort of big upside surprises, the best thing to do is be in the mix in Sydney and Melbourne or London. So I do try to spend time in the big cities as well. Apply the same thing as well to your investing. So lots of property investors on the show. If you want spectacular long run results, you're much more likely to get that in central Sydney than you are in a remote mining town. It's just the way the world works. So play in a big pond.
So, Pete, you were talking about Wealth Retreat. Once a year, we get together on the Gold Coast with a group of already successful business people, entrepreneurs and investors. And you're right. I think a lot of the benefit doesn't just come from the education, but comes from the discussions you have with people at breakfast, lunch, dinner, at nighttime. While there's some very successful people there, they leave their Superman capes at the door. All the egos are gone. And you have a chance of getting a different perspective, because we're going into these difficult times, these uncertainties, with our biases, with our worries, with our concerns. And social media is not making it any easier at the moment. They say you shouldn't turn on your iPad and your phone or read the news first thing in the morning. Unfortunately, I do. And
Me too.
at times hard to stay optimistic. Fortunately, I am, and I've been an optimist all along. But I think that's another issue with forecasting, that some people are overly optimistic. Others are pessimistic. Now, we've talked about this before. Some forecasters just keep getting it wrong, but they keep kicking the can down the road. There's one popular one who said the property market was going to go down 40%, and it didn't, and he's been in the media again, and now it's going to go down 40% because the coronavirus, he never predicted the coronavirus 10 years ago when he said it was going to go down 40%. They don't get it right.
No, so there's an old saying in investing that being early is indistinguishable from being wrong, and I think for investors that is largely true. I think there's another thing in predictions as well, is that sometimes people simply need a prediction to be true because they've made it so many times before. So I do know that in Ireland there was all this talk about the housing bubble, 4, 5, 6 years before it happened. Prices tripled and then they crashed. So the predictions in some ways were right, and in other ways they were just too early. So, and a lot of people, of course, in hindsight, tried to portray themselves differently from what they were saying in real time.
Have a look at all the predictions about the mining booms and where the next hotspots are. They're the sort of predictions I see in the media still again now, but wrong. For example, recently, one of the big portals was had in their blog the top growth areas last year, but I actually looked at a couple of them because I didn't recognize the suburbs. And one of the suburbs that grew really, really strongly and on the top of their list currently, when I looked, had 3 properties for sale. So statistically, it doesn't matter. But if one property in that small country town increased in value for whatever reason or sold, that pushes up the statistics. That doesn't mean much, though, does it? That's a fallacy.
No, well, that's just garbage in, garbage out. Yeah, we saw this years ago in places like Port Augusta, and people were saying, "Oh, it's delivered 13% per annum for however many years." But all that had really happened is that some land had been released and sold at cheap levels, and then people built on it, and then obviously prices were higher, but there wasn't any capital growth, and there hasn't been for donkey's years. I think the problem with that type of forecasting and prediction is it's simply built on the wrong model. And that's one of the reasons that I've learned so much from you as a mentor over the years is that you've got a proven model. You'll never be able to predict markets to a decimal point, but you don't need to, as long as your model is good and your framework is good. Then stick to the proven and tried and tested, and you'll do just fine, even if 1 and 2 year forecasts aren't right.
Well, a lot of people ask us, are you going to, if we use your services at Metropole, give us 10% capital growth or 7% capital growth? And I don't pretend we can forecast that because I don't know what's ahead. I don't know what interest rates are going to do. But what I can do with our model is show that we can outperform the averages. And we can do that by having the top-down approach of choosing the right locations that are going to have economic growth, jobs growth, wages growth, population growth. That's going to drive demand. On the other hand, also areas where there's not going to be oversupply, and then choose the right properties in those locations. So that allows outperformance. I can't do that in the stock market, but I believe I know you're better than me at that in the stock market. So while you can't predict exact results, I think the aim is to just do better than average, because average isn't very good, Pete.
No, that's exactly it. So you've got the perfect model for real estate. You stick to high capital growth, proven locations. So stock market's a bit of a different beast in many ways, and it's very unpredictable day to day, week to week, month to month. But what you can do is look at valuation. So there's a handy tool, the CAPE ratio, for example. That can tell you, roughly speaking, what your expected returns might be over the coming 10 years. And if you pay too much, the expected returns are low. And if you pay a cheap price when everybody else has got out, the expected returns are high. And there's a very strong correlation between the CAPE ratio and expected returns. So there is a model that you can use. You can't predict day to day or month to month what the market's going to do. But just like in real estate, it's just about thinking in probabilities. It's not about yes, no answers or trying to predict things down to decimal points, because you can't do it. It's about having the right framework and the right model and the right strategies.
Thinking about property, some people suggest, hey, there's infrastructure going into this area, so therefore there's going to be growth, and they're forecasting growth based on that. I know in particular the Sunshine Coast of Queensland, people were saying a university is coming there, a hospital's coming there, so that's going to have capital growth. Not all infrastructure leads to capital growth. Similarly, they say it's a growth area because there's large population growth, but population growth doesn't necessarily translate to capital growth because of the extra supply of accommodation that's there. In fact, this extra supply is the opposite of what you want for capital growth.
Oh, totally. Yeah. I think we talk about correlations, the correlation between infrastructure announcements and capital growth is pretty weak, because and people, it goes back to what we talked about in a previous episode about confirmation bias. People pick an area and then they read all the news and say, oh, there's a new milk bar opening in the area, or whatever. They look for all of the reasons why it must be a good investment, but that's not really what drives real estate values. It simply comes back to where is the demand highest, and it's good school zones, it's close to transport links, it's inner and middle ring suburbs, and where is land and supply at its most scarce. It's infrastructure projects. Well, they can be a short-term boon for some areas, but I wouldn't base my investing approach and my future wealth and security around it.
Well, we're human. We're not going to change. We are going to look for certainty. We are going to listen to people's forecasts. And unfortunately, as you said, our confirmation bias is going to make us believe or not believe those forecasts because of our preconceived ideas. But hopefully the chat that we've had today is going to just make it easier for people who've listened to it to recognize that don't believe everything you hear. don't believe everything you read, and particularly on social media, because there's a whole new breed of people around at the moment. The beginning of this property cycle that's occurred around a year or so ago has brought out a whole new group of experts, Pete, but they actually don't have the perspective that people like you and I have had who've lived through a couple of these cycles.
No, in fact, I sometimes look back at when we started investing, and especially in property. There just in Britain, there just wasn't all of the information that's available today. Just wasn't there. So all we could really do is rely on common sense. And I actually believe when it comes to investing, one of the most important things is actually understanding human behavior. And if you look at the most successful investors in history, Jim Simons, for example, is a mathematician. George Soros, he's more of a philosopher than he is a financial guy. And it's all about just understanding human behaviors and patterns. And yes, in real estate, patterns can change a little bit, but, most often people are more similar than they care to admit. So our theory was always, as young professionals, locations where we want to live, close to transport, amenities, close to the employment hubs. I would say 80% of what we did was just common sense, and much of that still applies. And when people start looking further afield for newfangled ideas, that's when they tend to go off track.
Now, to finish off, Pete, I'd just like to mention that you've got a new book coming out next month in April. Do you want to just tell us a little bit about that?
Sure. So I've co-authored the book with Stephen Moriarty. The book is called Low Rates, High Returns, with Wilkinson Publishing, Dimmocks and all good bookstores. And it's about how people should position themselves in this new era of low interest rates. So it's good timing because I think we'll see record low interest rates in 2020, but also stock markets are now imploding. So I think people are waking up to the idea that they can't, they needed the right framework, and you can't just rely on markets always going up because that's not how it works. So yep, it's good timing and really looking forward to getting it out there.
Well, if you're listening to this podcast when it's first released, the book won't be out yet, but what we're going to do is put a link in the show notes so you can find out more about it. I'm also going to link to Pete's regular daily blog, which I love reading because of all the charts and his interpretation of things. I'll give you a link to his Go Next Level Wealth blog as well, where there's some more great videos. And of course, you can get more of Pete on Property Update and regularly twice a month on the Michael Yardney podcast. Thank you so much for your time, Pete.
Always a pleasure. Thanks so much, Michael.
In a moment, I'm going to share my mindset message with you for this week, and they tend to be amongst the most popular segments of the show, judging on the feedback I'm getting. But before I do, I'd just like to follow through with some thoughts following the discussion with Pete about property forecasts. If you want to profit from property, if you want to own the type of investment properties that are going to outperform the market, over the long term, without the risks most property investors face, particularly these challenging times, and boy are they interesting times to say the least, my belief is that you're going to need to get a good team around you. You need an advisor who's going to take a holistic view on your wealth creation. And that's exactly what you're going to get from my team, the multi-award winning team at Metropole. You need more than just a buyer's agent. You need more than just a property strategist. Once again, we've won another award, Australia's Best Property Consultant 2020. Last year we won the Australia's Best Property Consultant 2019, plus a string of other awards. And that's because the independent team at Metropole don't sell properties. But if you're looking to create wealth through property, there's a range of services that we could help you with. We give strategic property advice. We do property plans, wealth plans, finance strategy. Sure, we have a buyer's agency with on-the-ground teams in Melbourne, Sydney and Brisbane, so we don't fly in and fly out. We have the sort of perspective that money can't buy. We also have a wealth advisory, financial planning arm, property management, renovations, development, and we give you ongoing portfolio review. Now, I don't know which of those services you need, but why not have a chat with our team at Metropole? Go to metropole.com.au or 1300 Metropole. You may choose some of our services or the complete one-stop shop. What would that be worth to you to have the best team on your side? One that will customize a solution to meet your specific needs. So go to our website, metropole.com.au, or ring us on 1300 Metropole. have an initial obligation-free chat to see what you want to achieve and if we are able to help you get there. I'd love to be part of your wealth creation journey. Now, let's get on with my regular mindset moment.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset moment, I'm going to share some lessons I learned from the late Jim Rohn, who was one of my early mentors, who taught me about the concept of personal development. I'd never thought of that before. He taught me I could have more than I've got because I can become more than I am. I guess he also taught me that unless I change, I'm not ever going to have more than I've got. One of his other lessons was, don't join the easy crowd. You won't grow. Go where the expectations and the demands to perform are high. We've spoken about this before, the importance of who you hang around with. And in one of his great lessons, Jim Rohn taught us that we face two choices in life. Each of us has two distinct choices to make about what we're going to do with our lives. The first choice is we can make it less than we've got the capacity to be, to earn less, to have less, to read less, to think less, to try less, and to discipline ourselves less. He also says, though, that these choices lead to an empty life. These are the choices that once made lead to a life of apprehension instead of a life of wondrous anticipation. Okay, so what's the second choice Jim Rohn was talking about? And that's to do it all. To become all that we possibly can be, to read all the books we can possibly read, to earn as much as we possibly can, to give and to share as much as we possibly can, to strive and produce, to accomplish as much as we possibly can. Jim Rohn taught me that all of us have got a choice, to do or not to do, to be or not to be all or to be less or to be nothing at all. Jim Rohn said, like the tree, it would be a worthy challenge for us to stretch upwards and outwards to the full measure of our capability. Jim Rohn taught me, why not do all that we can, every moment that we can, the best that we can for as long as we can? Our ultimate life objective should be to create as much as our talent and our ability and our desire will permit us to do. To settle for less than that would mean we'd be failing in the most worthy of undertakings. And so how do you measure how you're going? Jim Rohn said it's the results that are the best measure of human progress, not conversation, not explanation, not justification. So how do you know how you're going? The results. So just for a moment, be honest with yourself. How are you going? Are you happy where you are? Are you comfortable where you are in life? Are you where you hope to be? And if your results are less than your potential suggests they should be, that just means you've got to strive for more, to become more today so that you're going to be more tomorrow. Become more today than you were yesterday. The greatest rewards are always reserved for those who bring value to themselves and to the world around them. And as a result, you're going to become the sort of person you deserve to become. Some great words from Jim Rohn to live by. Now you've got two choices. Which one are you going to take? Live a life of comfort or be the best you possibly can be? Clearly we're living in interesting times, and I hope our chat today is going to give you a bit more guidance to help you move forward. So be careful whose forecast you listen to. And I guess in general in this time of uncertainty, be careful who you listen to. Don't listen to the pessimists. The challenges we're going through in the world are going to pass, as have all the other challenges I've been through in my 67 years of my life. You know, I've found that most of the things we worry about are things that have happened in the past or haven't happened yet, and you've got no control over either of those. So I'm going to be back twice a week chatting with you, helping you steer your way through these more turbulent times to be a more successful property investor by becoming more financially fluent, becoming more successful in all areas of your life, including money management. And if you got some benefit from today's show, please help somebody else who'd also like to move up the rungs of financial success by telling them about the show. There's a share button on all podcast apps, or just tell somebody about it. And if you really enjoyed it, why not tell the world about it by leaving a review on iTunes or wherever you listen to this podcast. And if I read it out, as I'm going to be doing for Monica's review in just a moment, email me, michael@metropole.com.au. And first of all, I'd love to say thank you. And secondly, I'll gift you one of my books as a way of saying thank you. Now, Monica left a long one, but please bear with me because I'm actually proud of what she said, what she's learned, and there's a lesson in it for you as well. So she said, and left a 5-star review on Apple Podcasts. Thank you so much. Hi, Michael. I want to say thank you for your informative podcasts and Facebook posts. I started listening to your podcasts after reading your book, Rich Habits, Poor Habits, with Tom Corley. Your recent podcast titled 10 Hard Truths About the Wealth Gap, well, that was a recap and a reminder about the things I learned and ultimately changed after reading the book. Despite coming from what I now have a name for, a poor habit family, I've always been a self-motivator, and at the age of 33, I already have achieved more than my parents ever did. Well, congratulations, Monica. That's fantastic. And I'm really proud. It gives me great satisfaction that our book has helped you. And Monica went on to say, however, after reading your book, I realised I still have a lot of poor habits, which to some extent I've accepted because I assumed that they were just baggage from my upbringing. But now I understand that the baggage is only habits, and habits can be changed. Thank you again. Kind regards, Monica. Well, Monica, your review made my day because I love passing on information and helping others. And clearly, you've already, as you said, done better than your parents. And at 33, the best is yet to come. Keep working on your good habits, get rid of some of the poor habits, and as I said, the best is yet to come. I'm going to be back again with another podcast for you real soon, twice a week. You're going to have me here telling you about property investment, success and money. But in between, you can keep contact with me on social media, a lot of videos on YouTube, regular blogs on Property Update every day. There's a newsletter, and as well as that on the other social media platforms, just look up Michael Yardney. In the meantime, I'll be back real soon. Have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?